Today, we begin with a development that tax professionals, financial advisors, and IRS insiders had feared, anticipated, and quietly prepared for. A rule change that unfolded not over years of congressional debate, but in a matter of months. Months that caught millions of taxpayers off guard. Months that left accountants scrambling to reinterpret compliance standards. Months that fundamentally altered how ordinary Americans will file their returns. What the Internal Revenue Service did today crossed a threshold that many in Washington had hoped would hold until after the next election. And when that threshold broke, the financial community did not hesitate. They responded with urgency, concern, and in some cases, outright alarm. Because this isn't just a policy tweak, this is a structural shift. And if you file taxes, and that's virtually every working American, you need to understand what just happened. For 18 months now, there had been signals, not official press releases, not formal Treasury announcements, just signals, that the IRS was preparing something unprecedented. The agency has been aggressive, yes, but they have been methodical in their aggression. Their enforcement actions have followed a certain rhythm, a predictability, almost a choreography. But what set off alarm bells in Washington and on Wall Street this spring was that the rhythm went silent. Tax attorneys who monitor IRS activity know the indicators. The unusual rulemaking sessions behind closed doors. The sudden reassignment of senior enforcement officers. The quiet expansion of data-sharing agreements with state agencies. The sudden pause in public guidance updates. All of that went quiet, and whenever the IRS goes quiet, it means something is about to get loud. For years, tax professionals have operated under a set of assumptions about how the system works. They understood the boundaries. They knew where flexibility existed and where hard lines were drawn. But those assumptions? As of today, many of them no longer apply. The 2026 rule change that took effect this morning represents the most significant overhaul to individual tax filing requirements in over a decade. And for millions of Americans, especially seniors, retirees, and self-employed filers, the implications are immediate. Early this morning, the Treasury Department published what they described as clarifying guidance on income reporting thresholds, including documentation requirements that had not been enforced in over 15 years. These are the kinds of compliance measures that the IRS only activates when they are signaling something very specific: expanded audits, tighter enforcement, or a complete reset of taxpayer expectations. Financial analysts didn't know which category this fell into, or whether it fell into all three at once. But what they did know was that the IRS was changing posture. And when a federal agency with this much power shifts posture without explanation, even by small degrees, the entire financial ecosystem pays attention. Here's what the new rule actually does. Starting today, individual taxpayers must report certain income streams that were previously considered de minimis, too small to matter. The threshold for 1099-K reporting, which covers payment platforms and gig economy income, has been reduced dramatically. Side hustles, freelance work, online sales, activities that millions of Americans engage in casually now trigger formal reporting requirements. And the documentation burden? It doesn't fall on the platforms. It falls on you. The warning issued by tax advocacy groups tonight was not normal. It was not routine. It was not symbolic. It was urgent. Advisor after advisor, CPA after CPA described the IRS's move as aggressive, poorly timed, and perhaps most importantly, retroactive in its implications. That last point matters, because the rule change affects income earned in calendar year 2025. Income that many taxpayers had already assumed was handled. But enforcement only works if taxpayers comply. And based on what we're hearing tonight, compliance is going to be a challenge. In fact, the response from the professional tax community today was among the most unified we've seen in years. Here's what we know. Within hours of the rule taking effect, the American Institute of CPAs issued guidance urging members to contact clients immediately. These weren't routine reminders. These were urgent advisories, the kind of communications that tax professionals only send when they are preparing for significant client exposure. The National Association of Tax Professionals followed with similar guidance. So did the National Society of Accountants. When three major professional organizations align this quickly, it tells you something important is happening. Tonight, Treasury officials confirmed that the IRS will begin automated matching on income categories that were previously flagged only during audits, including gig economy payments, cryptocurrency transactions, and rental income from short-term platforms. The IRS moved before most taxpayers could adjust their record-keeping. They activated enforcement on platform-based income. They activated enforcement on peer-to-peer payment apps. They activated enforcement on categories that were likely operating under outdated assumptions. In other words, the IRS targeted the gap between what taxpayers thought was required and what is now actually required. The compliance infrastructure that would have made this transition smooth. This is what made the advocacy group's warnings so urgent. The IRS's move wasn't just administrative, it was operational. It represented the kind of shift that could generate millions of unexpected tax bills if left unaddressed. And taxpayers, understanding that slowly, are responding with concern. Not panic, not denial, but genuine concern. They're not ignoring the change. They're not assuming it won't affect them. They're contacting their accountants. They're reviewing their 2025 records. They're asking questions they've never had to ask before. And here's where the story becomes even more significant. Tax policy experts now believe that the IRS's latest move was designed to test the compliance capacity of the American taxpayer after years of reduced enforcement funding. The IRS wanted to see whether taxpayers would scramble, ignore, or adapt. But instead, something unexpected happened. Taxpayers didn't ignore. Tax professionals didn't minimize. They mobilized with a speed and coordination that was so rapid, so organized, that even the IRS noticed. You don't get the federal government's attention easily. But today, the professional tax community did. Policy analysts speaking with financial media under background rules described the IRS's shift as a capacity probe, a way to test whether expanded enforcement is viable before committing additional resources. But the professional community proved today that they remain both vigilant and vocal. Their responses were not only immediate, they were coordinated so precisely that unified guidance reached millions of taxpayers within hours. That coordination matters because it shows something important. It shows that the tax professional community is not passive. They are not waiting to react. They are anticipating, preparing, and mobilizing. As reports continued coming in throughout the day, we learned more about the scale of the IRS's new enforcement posture. Payment platforms like Venmo, PayPal, and Cash App will now report transactions exceeding $600 annually, down from the previous threshold of $20,000. Cryptocurrency exchanges will implement cost-basis reporting for the first time, forcing investors to track gains with precision they've never needed before. Short-term rental platforms like Airbnb and VRBO will share detailed income data directly with the IRS, eliminating the gray areas that many hosts relied upon. This wasn't just a policy update. This wasn't just a threshold adjustment. This was an information infrastructure overhaul. This was a compliance architecture redesign. And compliance architecture is the one thing many taxpayers have struggled to maintain since the gig economy exploded. For every workaround they have developed, the IRS has now countered with something that closes the gap. Remember, the IRS thought taxpayers would adapt gradually. They thought the transition would be seamless. They thought the professional community would absorb the change quietly. But tonight, the exact opposite is happening. Taxpayers are confused, professionals are overwhelmed, and the timeline for compliance is impossibly short. The last time the IRS attempted a shift of this magnitude was in 2013, when the Affordable Care Act introduced new reporting requirements. That rollout was rocky. This one is already proving to be more challenging, because unlike healthcare reporting, which affected specific categories of taxpayers, this rule change affects virtually everyone who participates in the modern economy. And that's a lot of people. What makes this moment so critical and so politically charged is that the IRS's latest move happened at a time when the agency is under extraordinary pressure. Congressional Republicans want reduced enforcement funding. Congressional Democrats want expanded taxpayer services. The Treasury Department wants compliance revenue. And taxpayers want clarity. IRS Commissioner Daniel Werfel is balancing these demands while implementing the largest technology modernization in the agency's history. And when agencies in that position make sudden moves, they're not doing it from strength. They're doing it from pressure. They're doing it from mandate. The Inflation Reduction Act allocated billions to IRS enforcement. Those dollars came with expectations, and those expectations are now being converted into action. The Treasury Department's guidance, now available on irs.gov, was designed to signal that the government is not willing to tolerate continued underreporting. Officials said plainly that the previous thresholds were inconsistent with congressional intent. That is bureaucratic language for the old rules were too lenient and we're done being lenient. You don't usually hear that tone from Treasury unless something serious is at stake. And what's at stake is significant. The IRS estimates that the tax gap, the difference between what's owed and what's collected, exceeds $600 billion annually. This rule change is designed to close part of that gap. Whether it succeeds depends entirely on how taxpayers respond. Meanwhile, IRS Commissioner Werfel addressed reporters in a measured but firm statement this morning. He said, "These changes reflect the reality of how Americans earn income today." He said, "Our goal is not to burden compliant taxpayers, but to ensure fairness across the system." And he said, "We understand there will be an adjustment period, and we are committed to providing resources to help." These are not empty reassurances. These are statements from an agency that understands just how high the stakes have become. The IRS knows this rollout will be scrutinized. They know taxpayers are anxious, and they know that the next 12 months will define whether this policy is seen as necessary modernization or bureaucratic overreach. Here's what makes the situation even more concerning. The IRS's latest move wasn't isolated. Along with the reporting threshold changes, state tax agencies have also announced enhanced data sharing agreements with federal authorities. The Financial Crimes Enforcement Network has expanded its beneficial ownership reporting requirements. The Social Security Administration has increased cross-referencing of income data for benefit calculations. All of this happened within the same fiscal quarter. When multiple federal agencies move together, it means something larger is underway. This isn't just tax enforcement. This is a coordinated effort to close information gaps across the entire federal financial infrastructure. And if you've been operating under old assumptions, those assumptions are now liabilities. Tax analysts are now considering several possibilities. One is that the IRS is preparing for a significant audit surge targeting middle-income taxpayers. Another is that the IRS is attempting to normalize higher compliance burdens before expanding them further. A third possibility, the one worrying professionals the most, is that the IRS is attempting to shift enforcement costs onto taxpayers themselves. But today, the professional community took action. They didn't wait for clarification. They didn't minimize the impact. They didn't tell clients to ignore the changes. They mobilized. They communicated. They prepared. What we're watching now is a test of adaptability. The IRS wants to see whether taxpayers will comply without resistance. Tax professionals want to show that their clients are prepared. Congress wants to prevent political backlash. And taxpayers want to avoid unexpected penalties. Everyone has something at stake, and the next filing season will reveal who is ready. Tonight, we've heard from tax professionals who are now reviewing client files urgently. They say the documentation requirements are more extensive than initially understood. They say the timeline for compliance is unrealistic for many small business owners. And they say the IRS's decision to implement mid-cycle is likely part of a broader strategy intended to maximize first-year compliance revenue. But taxpayers are not paralyzed. In fact, taxpayers are adapting. Their response today, rapid, organized, and informed, sent a message to the IRS that Americans take their obligations seriously. And it sent a message to Congress that oversight of this rollout will be essential. As the week goes on, we expect more details to emerge about what exactly the IRS hopes to achieve with this accelerated timeline. But what we do know is that the professional community's response was timely. It informed millions of taxpayers who might otherwise have been blindsided. It created pressure for additional IRS guidance. And it established a framework for organized advocacy if the rules prove unworkable. What happens next will depend on what the IRS does in the next 90 days. If they provide meaningful relief, this moment will be remembered as a difficult but manageable transition. If they maintain rigid enforcement, the professional community has already shown they are prepared to push back. They have shown they are ready to advocate. They have shown they are ready to protect their clients. And tonight, for the first time in years, the IRS appears to be listening. Washington is watching. The tax community is mobilized. And when this many stakeholders are engaged, it means the outcome is not yet determined. It means the final shape of enforcement is still being negotiated. Because tonight, the IRS learned something they should have anticipated. Americans pay attention when their money is at stake. Americans organize when their interests are threatened. And Americans adapt when they understand what's required. This story is far from over. But tonight, one thing is clear. The rules have changed. The stakes have increased. And the 2026 filing season will be unlike anything we've seen before. And we will be here, covering every development as the next phase unfolds.